The state pension is approximately 13,000 odd, and is that going to maintain you when you get to retirement age and beyond?
Welcome to Financial Foundations with Thomond Asset Management. I'm Neal Kelly, founder and director of Thomond Asset Management, and today I'm joined by David O'Neill, fellow founder and director, and our special guest, Steven Garavan from the Independent Trustee Company. Today we're going to talk about probably what is, for a lot of time, considered quite a boring subject. People kind of throw their eyes up in their heads when we talk about pensions. But because I suppose they're wrapped up in confusing terminology, they're wrapped up in taxation, and people just, let's face it, their eyes glaze over when we talk about pensions or when we get into it. But I would argue, without fear of contradiction, or maybe you will contradict me, that there isn't another investment structure in the land that is as good as a pension, because they pretty much instantly provide a return. And I suppose we'll get into that in a minute. But I suppose in that sense, pensions make a lot of sense. I suppose I'll start with you, Steven. I mean, outside of your own plans for retirement, we have, or the state provides, a certain level of pension through our PRSI contributions over time, etc. But, the question we typically ask is, could you live on the state pension in retirement?
Well, that's a big question, Neil, because when you consider that the state pension is approximately 13,000 odd, and is that going to maintain you when you get to retirement age and beyond, live to 75, 85, 90 or beyond? And is the level of rental income, is the level of state pension going to sustain you for that duration? So it's a very serious question that needs to be addressed in and around pensions.
Yeah.
And also, when you look at the retirement age, which has been slowly creeping up over the last number of years.
For the state pension.
That when does that kick in, and when am I actually going to be able to get access to those funds? And
there is talk of them, there's been a lot of confusing talk in terms of that, but it has been pushed out. I think under the current regime, we're probably going to get it at 67? Is it 67, 68 if we're lucky? I personally, knowing the maths, I could see it being pushed out much further. But I am making a prediction. So, here comes the thing, in Ireland, life expectancy is increasing, healthcare, all that kind of stuff, Dave, there's pretty significant implications on that.
Definitely. I think the gap between men and women outliving each other is completely narrowing. So men and women are not, men are living a lot longer, thank God. So we have that element of it going on, but people are living now, the average man now could live up to 84 years of age. When you look back at pensions years ago, defined benefit pensions and stuff like that, they were devised when longevity wasn't there and the average man lived to 69, and then the pension passed on to the wife till she was 74. We've completely moved out of that dynamic now, and people are definitely living longer, and they're doing a report to review it, but realistically, when you start to look at the maths of it, because we would be in the industry and we would know more about I suppose the funding elements of it, that it's going to really substantially impact on people in their 40s today, 20s, 30s. Definitely they're the people that are going to be 70 years of age plus before they're going to be looking at a contributory pension.
I suppose back to Stephen's point, the 13 grand a year, the value of 13 grand, I suppose for us in 15, 16, 20 years time is really, it's nothing. Even with inflation, if it's added to it, it is only meant to be keep the lights on type.
Absolutely. I think any person that knows any person that lives on an old age pension, I think that answers its own question. I think nobody on an old age pension today is not struggling.
Yeah. A number of years ago, I don't know if they've updated the information, but the average pension at retirement privately, if people managed to do that, was 140,000. So people hit retirement at 100, at 65, whatever, 66, and all they had was 140,000 saved. That's not really going to go too far. I read recently as well, I don't know if you saw this, that after COVID, some data has come out that some people were surveyed. 57% of private pension holders were surveyed, and 25% of them have decided to amend their retirement planning. In other words, people have, because of COVID, have extended the age at which they are aiming to retire. So I suppose the true implications of not making plans and not planning for that are pretty kind of apparent. Now, I'm going to come back to it. Dave and I live this every day, but income tax relief on pensions. So, Dave, I suppose, obviously this is convoluted subjects, so to be a little bit careful, but, how does it work for a client, for a person? He wants to kind of say, right, I want to start saving today into a retirement plan. I don't want to say pension, because really pension really is what you get at the end, but into a retirement plan, what does that mean? I suppose,
when you look at it, I suppose the first thing to do is to think of the period of investing. So the longer you leave your money invested, so the younger you start a pension, believe it or not, makes such mathematical sense. Even if it's only a small pension and it grows and so on and so forth as you move through life. So you get tax relief at source. And I suppose everybody knows that part of it, and they think that that's the most attractive thing in a pension. And don't get me wrong, it is very attractive. So if an individual puts €100 a week into a pension, then he gets €40 back if he's on the marginal rate and 20% if he's on the lower rate. So he's getting tax relief back, which helps him to fund that €100 per week or €400 per month. The most overlooked part of a pension is the tax efficiencies of the gross roll-up. Yeah. So basically compounding. Most people will understand compounding through their mortgage. You borrow 300,000, but you pay back 600,000, because it's the compounding effect of interest rates, money on money on money over a compounding period of time, that really is the most underlooked part of a pension. And in every aspect of investing in Ireland, there is capital gains on growth on every single thing that you will make a profit on, except for a pension and your personal private residence. So pensions, to me, the most attractive thing to a pension, if I was getting no tax relief on it, and there was a survey done on that as well, the efficiencies of actual no tax relief, and it still makes sense.
The gross roll-up is, it's probably one of the, people they generally don't understand it. We come to a previous conversation we had with regards to property and rental income. Outside of a pension, you pay income tax on the rent roll. Within a pension, there is no tax. And it's allowed, so basically the value of your assets are allowed to grow.
Correct.
Unencumbered by tax. Now, you're not avoiding tax, you're delaying it, you're deferring it. But, the mathematical exercise in that is incredible over a long period of time, because a pension is a long
20, 25 years, 30 years.
Yeah.
It's huge.
It's massive. I suppose, look, Stephen, pensions are, I like to call them long-term savings accounts, for retirement. But within that, you have a lot of options. People think of pensions, they don't really think them of investment vehicles, but they are quite a flexible, platform to which to invest. What options typically do clients, people have when it comes to a pension?
Typically in the area that I look after in the self-administered side, you would see, as discussed, property would be a very strong candidate. You'd also have the full range of funds that are there. But the biggest choice that clients look for in that particular area is the whole idea of control. They want to be able to control what they invest in. They may be coming from a scenario where they're in group pensions or other occupational schemes, and it's over in the ether, and all of a sudden it doesn't kind of quite catch with them. So they want to take an element of control or full control of it. Now, if they're prepared to do that through taking financial advice from Thomond and actually go the self-administered route, they have the full suite of investment options there that are available to them. And as I already highlighted with regard to the tax reliefs that are there, it's a very strong incentive, because straight away, just going back to the property example, well, revenue are paying half it. Now, you don't say that with revenue in the room, but...
Well, it goes back to the point with Dave, you're instantly getting tax relief. There isn't another investment in the land that gives you
exactly
your rate of tax back instantly. Think about that. You put in €100, that's instantly 40%. People don't get that, and it's often missed. It's a very valuable thing to kind of get your head around. So in terms of investing, particularly in the self-administered, I suppose they do have the full gambit of investment assets.
Absolutely, yeah.
People have trading accounts. They can trade equities and shares. They can buy property. They can, they can go into funds, normal funds that they're probably very familiar with.
The full suite is there, absolutely, Neil. Yeah.
Yeah, okay, so people get to retirement. They've a whole ball of money sitting there. They have a series of options. At retirement, I always kind of play this one through when I talk to clients. Is that okay? When you get to 65 or 66, whatever your chosen date is, you do have some options. What option? What does it look like? What do you get? At the end of the day.
Well, typically, say in your typical group occupational scheme, what would happen if you just let it run, that the trustee will effectively go and buy an annuity for you.
Yeah.
And as you know, and Dave knows, that in the current environment, annuity rates haven't been great.
No.
They've improved slightly, but they're still not great. So that'll keep running until you stop running. And that's basically it. Whereas by moving it, say, to something like a self-administered scheme, that effectively, when it comes to retirement, that you can retire that scheme and then take a tax-free lump sum. But
you do get a tax-free lump sum in a group scheme as well, but it does come with the limitation of having to go into an annuity. So you essentially get 1.5 times your final salary potentially.
Yes, exactly. Yeah.
And again, there are rules and caveats around that, so a little bit careful on that. People don't want to look that one up, but you do get a tax-free lump sum at retirement, which is obviously very beneficial. But I suppose back to your point, I'll give it to Davey. One of the other options is the approved retirement fund.
Yes.
So, what's an approved retirement fund, and how do you get there?
I suppose the first thing, you start a pension. You eventually get there. You get to retirement. You retire your pension. They'll take 25% of the fund tax free to your lifetime limit of 200,000, depending on the size of the fund. If it exceeds 800,000, there's a tiny bit of tax to be paid, 20%. But once you have your ARF, then I suppose what the ARF really does, or the approved retirement fund, is it gives you different options, and you can have a combination of both. You can decide, I'll have a guaranteed income with half my fund, and so it really does come down to the advice at the time, bespoke to what the individual's needs are. The guaranteed fixed income for life has a load of pluses, but there is an argument where you look at the age ratio table that what do you need a guaranteed income for at 90, but you definitely need more income at 65 to 75. So the ARF gives you that flexibility to maybe take a €20,000 per annum income in those years and less income at a later stage, because the fund will depreciate down, where the annuity gives you that straight line, guaranteed bird in the hand approach. So it depends on what the individual...
we'll come to the inheritance thing at the moment, but I suppose...
And it doesn't die with you,
the annuity essentially dies with you.
Yes.
You can leave some to the spouse, but if you have an annuity, but an ARF gives you... I suppose, does it give you a bit more control over the longer term, a bit more flexibility in what you can do with it? The one thing I always tell clients is that you can change your mind with an ARF. So if you want to buy an annuity later in life, you can go back and because now, look, you wouldn't do it today. Interest rates are falling again, or we hope they are, but annuity rates are not great, particularly when you in your early 60s. They're not fantastic, but coming back to it. But I suppose so I give this one to you, Dave. It's a inheritance planning. The ARF is very good in that sense, in that, particularly for the husband and wife scenario. What happens on the demise of the ARF holder in that particular case?
Well, I suppose...
More to give people some peace of mind, because there's a lot of worry about that.
Back to Stephen's point he's made several times about control. People love control. They want to control their own destiny. They don't really like the concept of, most people that take out an approved retirement fund will not like the concept of a guaranteed income that will die with them, or a guaranteed income that's halved and then dies with their spouse. So if a person has a fund, let's say of €400,000, he's taking an income out of it, something happens to him, it transfers tax-free to his wife. So she gets the full benefit. So if he was on an income of 10 or 15,000, she'll benefit of that 10 or 15,000. Then, God forbid, if something happens to the wife, the balance of whatever's left in that fund goes to the estate, it will pass to the children, and is subject to income tax, or subject to tax at 30%.
CIT, yeah.
So it doesn't actually come off their CIT threshold. It's actually it doesn't qualify.
It doesn't qualify.
So have to be careful of that too. So people think that, I can leave my daughter the pension and she has a threshold of 335,000, and you realise you paid a 30% tax anyway. So there's a bit of planning. You definitely have to do a bit of planning, but I think the reality of it is that people like the idea that the fund stays with, let's say, the husband and wife throughout their lifetime for as long as it lasts. But more importantly, that at least 70% of it goes to the estate as opposed to dying with you. And that is probably has seen a big sea change on an awful lot of more people going towards ARF. Than annuities would be. Realistically, they're very rare.
Yeah.
You know?
I mean, in the last couple of years, there's been big changes in terms of pensions and structures, and the term PRSA is coming up quite a bit. And the last couple of years, there's been kind of significant changes that have made a PRSA more appealing. Now, sorry, when I say PRSA, just for clarity, it means a personal retirement savings account. At the end of the day, it is just a pension structure. But there's been talk, I suppose I'll give this one to you, Stephen, it probably fits more in the self-administered world. There's been talk that people have been able to put an unlimited amount into a PRSA without seeking revenue approval to do so. Could you kind of elaborate on what those kind of situations have, how that conversation has come about?
At the last Finance Act, the employer could make a contribution into the PRSA, and it was unlimited. Heretofore, there was benefit in kind for that contribution. Now, the individual also had their personal threshold as well that they could put in. And that opened the door for fairly significant contributions to be made into the PRSA. And from a corporation tax point of view, without getting into the technicalities of it, basically they could write that off in the accounting period in which the contribution was made. So it made an awful lot of sense because it points to a time, and various governmental administrations down through the years have been made aware of the pensions black hole and the pensions time bomb. And unbeknownst to them, maybe they were starting to encourage people that might have been outside the pensions net to slowly but surely come into it. Yeah. And that kind of generated a lot of activity in that regard.
But as with all things, these things are prone to review. I mean, there is a lot of talk this year that particular scenario, because it reverts back to previously you had thresholds, age-related, salary-related, for the self-employed, company directors, slightly a funding calculation needed to be done. There is talk about that changing for the PRSAs this year.
There is indeed,
or in the next Finance Act, we would say.
Without knowing what's on tomorrow's newspaper, but absolutely there is a lot of chatter about that, and seemingly there's been fairly high-level meetings held in relation to it. Okay. So we'll just have to wait and see what comes out after the budget, and whether the Finance Act will be brought forward from its traditional time of...
but no matter how we chop it up, the contributions to the pension are still very valuable and very worthwhile exercise to do. Anyway, guys, look, thanks a million for that. Again, guys, if anyone faces any issues in regards to pension contributions or have any particular questions, please feel free to contact us. Our contact details will be below. We'll be more than happy to talk you through any of your issues. Thank you and goodbye.